Oil prices are rising quickly and markets are starting to pay attention. Could higher energy prices become a headwind for markets in 2026? Today we'll break down what's driving oil prices higher, what it can mean for inflation and the economy, and what investors should be watching next. I'm Eric Pettway, Chief Investment Officer at Journey Advisory Group, and welcome to CIO Corner. Last week, markets pulled back slightly. The S&P 500 declined 2% and the NASDAQ fell 1.2%. The S&P 500 is now down 1.4% for the year. International markets also declined last week but remain ahead of U.S. equities so far in 2026. Over the past 2 weeks, we've reduced exposure to emerging markets and increased fixed income holdings. The goal is simple: help preserve capital during periods of uncertainty while still positioning portfolios for long-term opportunities. A major factor influencing markets right now is rising oil prices tied to tensions in the Middle East and disruption around the Strait of Hormuz, one of the most important energy shipping routes in the world. As oil prices have climbed, gas prices in the U.S. have increased significantly, which can ripple through the broader economy. And that brings us to this week's Chart of the Week. Today we're focusing on oil prices and why they matter for the global economy. Oil is one of those commodities that touches nearly every part of daily life. It affects transportation, manufacturing, food prices, and overall cost of goods and services. Because of that, changes in oil prices can influence inflation, consumer spending, and economic growth. Right now, Brent crude is trading around $103 per barrel, with West Texas Intermediate just below that level. Much of the market's attention is focused on the Strait of Hormuz, a narrow waterway that connects the Persian Gulf to global shipping routes. A meaningful share of the world's oil supply moves through this channel each day. Recent disruptions and security concerns have made oil markets more volatile as traders respond to both supply risk and efforts to keep global shipping lanes operating normally. There are also reports that some oil-producing countries may adjust production levels, which can further tighten supply in the short term. When oil prices rise significantly, it can feel like an extra tax on households because energy is part of nearly everything we buy. And since consumer spending represents more than 2/3 of U.S. economic activity, higher fuel costs can reduce how much money households have available for other purchases. That said, it's important to keep some perspective. Even with the recent increase, oil prices remain below the peaks reached in 2022, when prices briefly climbed above $120 per barrel. At that time, inflation was already elevated following the pandemic, which amplified the impact on the economy. Today, inflation has been trending lower, which means the broader economic environment is different. The key question now is how long oil prices remain elevated, which will depend largely on global supply conditions and geopolitical developments. The chart we're showing today highlights the historical components of gasoline prices, illustrating how crude oil prices are the primary driver of what consumers ultimately pay at the pump. That's why oil is closely watched as both an inflation indicator and an economic signal. While short-term energy prices spike can create economic headwinds, history shows that markets and economies tend to adjust over time. Maintaining a long-term perspective is often the most important factor when navigating periods of uncertainty like this. We hope CIO Corner and the Chart of the Week help provide helpful perspective on these current developments. If you enjoy this content, you can follow Journey Advisory Group on LinkedIn or subscribe to our channel for future updates. And if you have questions about your portfolio or long-term financial plan, reach out to your Journey Advisory Group advisory team. Until next time, remain calm, stay focused, and most importantly, stay the course.